The biggest change that I have seen in the past 9 months are the crypto native exchanges, that these brands that have literally hundreds and hundreds and hundreds of millions of users across the planet. Those users are desperate because of the stagnant prices in the crypto digital asset space to make money, to be investing and broadening their investments beyond just crypto and digital assets. And that's why there is a massive effort by these brands to grow their real world assets, their TradFi experiences aggressively as they can.
Hi everyone, welcome to the Converge podcast. I'm here today with Roger Bayston, head of digital assets at Franklin Templeton and the incubator of Franklin Templeton's journey in digital assets. So it's really great to have you on the show. Welcome.
Thanks, Chris.
Yeah, so maybe it would be great to start by getting to know you better, and how did you end up becoming the advocate for digital assets within such an important organization in capital markets?
Great question. I had a general strategy for a long time in my career. I've been at Franklin Templeton since 1991. So I guess it's rare that you find somebody who spends so long at one specific institution. My roles have changed a lot over the years, and some of that is because of the way the markets evolve. Another thing is just like, my own intellectual curiosity. I had a pretty good strategy a long time ago to hire people who were much smarter technically than I am. There's something to be said about, gray hair and wisdom and experience across different market events and cycles. And since I've been kind of in the institutional investing space since 1986, I've seen a lot of different things, a lot of that experience. But these super smart people that I would hire had a vision that we needed to be able to scale business by having a lot more technical capabilities. I figured if people had really high technical capabilities, I had been working in the fixed income part of our business for lots of years. Present value and the first and second derivative of present value, which we call duration and convexity. I figured I could teach up that math to people who had all these, various technical abilities. But literally what it allowed me to do was to be able to make time to just pay attention. So many times in our work lives, we got this task list today. We got 10 meetings today. We got to get through them. And then, tomorrow is the same sort of stuff. But I was able to scrub my schedule to be able to pay attention to things. And one of the things I was paying attention to was distributed ledger technologies. I mean, all of these years of experience in capital markets and asset management, I was just aware that ledgers and records were everywhere. So this seemed like a technology that could be disruptive. And, that word disruptive can be meaning two things. One can be, this could have a really serious impact on your current business. Could be one of those ways it's disruptive. But the second way it could be disruptive is, hey, it could, bring forward a whole bunch of new opportunities. And so I just started paying attention to it. I just started writing memos and having conversations with people that could tilt resources and have other same sort of intellectual curiosity. One of those persons is our now CEO, Jennifer Johnson. And I'd known Jenny for a long period of time, and said, hey, we should be doing something here. We should be thinking about doing something here. And that's kind of where things started. Jenny's background as the CEO of an asset manager actually was kind of interesting. Lots of people rise to that status of a leader of an asset manager because either they've been some sort of major alpha generating, investor themselves, or they've had like some superior marketing or, business development type of job capabilities. But Jenny actually came up through the operations at Franklin Templeton, and she quickly learned when we started doing some proof of concepts with our distributed ledger technology. Proof of concepts, as we started nailing through those, she more than anybody began to recognize the efficiency gains in that part of the business, the transfer agency part of the business in securities distribution. And so that was a really big turbocharge. But that's kind of how things started moving forward. And one thing led to another. And we started building products specifically built inside of the distributed ledger technologies like Benji, our tokenized money fund, and all the other array of things that are unfolding in front of us.
So if I understand correctly, you guys started as early as 2020. I think Benji was launched in 2021. So in many ways you were like pioneers in the space. How early are we talking?
Well, we had actually spent some years prior to that just thinking about, what could we do? How do we do it? And then having conversations specifically with the regulators about using the technology. And once we got them to the comfort zone, then we actually were able to launch Benji. But we were at this several years prior to launching Benji, the actual mutual fund itself, into the marketplace and having those conversations. It's really amazing to see how the entire environment has changed so dramatically during that time period, because I can remember it like, we were waiting to get meetings with the SEC,
Mm.
and we're talking about months, turning into lots of months, turning into like 6 to 7 to 8 months to have the next conversation. And of course, when you're having the conversations, you're like, reintroducing yourselves to a whole bunch of people, and you have
Yeah,
45
thing has
minutes,
changed.
like 20 minutes had passed and you've done the introductions, and now you can get into stuff. But yeah, it's a lot of persistence, a lot of investment, but we feel super confident that we're going to meet clients in these Web 3.0 wallets in
Mm.
the future. And so if we're going to meet clients in those wallets, we needed to be aggressive. It's a big business, globally. There's just trillions and trillions of dollars in savings. If the underlying environment is migrating toward this, then the investment and our time and attention is certainly worth it for the long term.
And we've had, you know, a dramatically different regulatory environment in the last couple of years with the new administration. So only last week we had the SEC issue a no action letter around the use of tokenized assets. And can you walk me back from where Franklin Templeton is in digital assets in the sense of like what you build and what you currently have in this space?
Yeah, sure. I mean, it all began with how can we use distributed ledger technology in our business? And it's interesting because we are an asset manager. And so, one framework that, you know, other asset managers could approach is, well, how do I offer advice on things
Mm.
here in this space? What are a portfolio of digital assets that, investors may want to be able to weave into their portfolios? But our experience was really about how can we use this in our business? And we, understood, you know, pretty early about the kind of the record keeping qualities of the ledger itself and the composability of it. And we knew in our underlying business of distribution of mutual funds, this is kind of a legacy business that we had a lot of success with over the decades. The biggest source of records that we had were in transaction records of underlying open-end mutual fund shareholders. So if you are a money market fund holder, let's say you own FOBXX, which is the underlying
Mm-hmm.
fund for Benji specifically, and you reinvest dividends on a daily basis, you're talking about, you, Chris, you as a shareholder would have, 200 plus records each year. There would be,
Mm-hmm.
your subscription, and then there'd be a reinvestment every day. There'd be another. Well, you can imagine if you have millions of shareholders, tens of millions of shareholders, globally, that these records are massive. These record keeping systems, exist in what we call the transfer agency process.
Mm-hmm.
You have transfer agency responsibilities along with the permissions to issue securities, and a mutual fund is a security. So that is where the database was that we were looking to try to integrate distributed ledger technology rather than these old monolithic centralized databases that
Right.
had existed forever and ever, built on technology from 15 to 20 years ago. That's where we just started we want to dig in deeper. We want to look at that transaction database. It costs money, so it feeds into the overall cost of a service that you're going to provide to customers and clients. And when we started digging inside of that and building a transaction record keeping system inside of the transfer agency, specifically as it related to using the blockchain and being on chain, by the way,
Mm.
specifically on chain. That was our goal and objective. It wasn't to have replicate this database system somewhere else, but we really wanted to be on chain. And this is where it took a lot of persistence with the SEC first, and now with global regulators as well, to say,
Mm.
hey, we are a centralized issuer of an asset. It's a mutual fund. It's FOBXX, it's Benji. We're just using the distributed ledger technology as a record keeping system. And we think it is a good control environment, and convincing them of all of that. But that's kind of really where we started. Now, when we identified what the efficiency gains were, which were just a fraction of our own internal costs and our legacy transfer agency record keeping system, that was our aha moment. Kind of in the same way that, Warren Buffett went to Dairy Queen and he chose the dip cone and he's like, my aha moment, this is a really good product. I'm going to buy these, for a long period of time. We began to realize, hey, these record keeping systems are going to be pervasive across the information-based economies and industries of the world. These are going to be better record-keeping systems than what currently exists for lots of different reasons. Therefore, there's going to be demand for this thing called a cryptocurrency that you need to transmit value within the underlying ecosystem. And so that kind of is what spilled forward when we say, okay, we want to offer advice on these things, because it was being a user first that gave us that perspective by and large.
So there are different paths there, because you alluded to digital assets, for example, and providing advice to people who are getting into this, like cryptocurrencies.
Yeah.
A second one would be what you mentioned around the underlying infrastructure and technology behind it that can have greater efficiency. And a third one would be what you mentioned around the sort of like intermediary institutions, like transfer agents, and composability, in the sense of whether do you actually need to replicate the same sort of like counterparty structure that legacy has. So out of the three, which one was more important at the beginning, and which one do you think is more important to you today?
Well, I would say all of them are, because in our journey toward building this underlying infrastructure, we have created quite frankly, most of the framing and the underlying factory for kind of a tokenization factory. Deploying that factory and bringing resources through it, at one end, and spitting out tokenized products on the other would be an end goal. But we have built that infrastructure specifically internally for Franklin Templeton. But man, we get calls every day of the week or connections that we make with people who don't want to go down that path themselves and want to be able to potentially use our kind of world-class services that we built alongside regulators to do that. So that's an important infrastructure thing. Again, we expect to meet clients in these Web 3.0 wallets. We expect to meet all clients there at some point in the future, because it feels like a better underlying ecosystem and offers more flexibility and adaptability for institutions and their clients moving forward. And so, that's kind of what's being unpacked now. It's a really interesting environment, because with asset values in digital assets and crypto over the past, 9 going on 10 months now being pretty stagnant, while TradFi assets are going through the roof. Your tokenization factory and your tokenization efforts need to meet clients somewhere. They need to meet clients in these wallets. And so where are the wallets? Until legacy TradFi financial services firms build out their digital wallet infrastructures, you're going to meet those customers and clients where the wallets actually exist currently. And there's two kind of general worlds of those wallets. There's the permissed wallets, which would have permissibility to own tokenized securities. And then there's the, permissionless wallets themselves. And so it's really interesting to see how the industry is kind of addressing both of those in order to bring products and services to both of those environments in the near term. I don't think there's a clear winner. I think we're going to continue to see the legacy businesses move toward this kind of infrastructure. But it's really interesting about how over the past months, the power has shifted somewhat. 2 years ago, you would have said a lot of these crypto native companies and industries would have been leading the edge. But with the stagnation of crypto itself, it has given a lot of catch-up time for the legacy businesses to build their own processes, to even, work on their own chains, that might not necessarily be a fully public chain, but will have the necessary underpinnings that help the capital markets and asset management. So it's really this pause in valuations in crypto in general, I think, have caused a big momentum swing to the legacy TradFi financial services firms to be able to identify this technology and resource, pivot a bunch of their resources toward it to create their own solutions rather than being overtaken by the legacy crypto players.
Yeah. And as we mentioned before, the regulatory environment is also a key enabler to help them, confidently enter
Absolutely.
the space. For people who might not be familiar with Benji and the tokenization factory you just spoke about, can you explain what it is and who it serves and how it works?
Yeah, Benji, first of all, is just simply, it's kind of a, a slang term we've created around securities offering, a 2A7 US registered money market fund.
Mm-hmm.
Money market funds are a pretty, standard savings plan in the U.S. They're kind of governed by the 1940 Act. Call them 40 Act funds, which is kind of interesting by itself. We could probably go down a whole rabbit hole on that. 40 Act. I mean, what are we at, like
Mm-hmm.
86 years later?
Exactly.
That's the technology, is this thing we call the 40 Act. But by and large, institutions and individuals have used money market funds because they're full collateralization. Can we say there's counterparty risk in a mutual fund or a money market fund? It's hard to identify it. I mean, it's a fully collateralized separate investment company by itself, right? With a lot of rules and regulations about the asset types it can own, because there's been there's been hiccups over the years. But it's a savings plan that has $7 trillion of trust by
Mm-hmm.
institutions and individuals around the world. And so this idea that it has a stable net asset value and offers income has been just the feature set of money market funds forever. Many years ago, institutions started putting check writing capabilities on top of money funds and then debit card capabilities as well. So, money funds are in the broad definition of M2 in the money supply.
Mm-hmm.
But what's really happening when you can move a money market fund into the blockchain environment and use the blockchain and distributed ledger technologies, and it's building the customer experience on top of that, you can take something that is adjacent to US dollar fiat and move it directly into competition with US dollar fiat, with the
Right.
primary difference is that it offers yield by and
Mm.
large, right? So it can move as fast as fiat. It can be transferred from one wallet to the next, literally in as fast as you can record a record on some of these blockchains, which is, fractions of a second. The real ownership changes. And what we have unpacked with Benji is the idea that however many seconds of the day that you own Benji, you will receive yield for that time period. This is a big unlocked feature set for something that has been one of the most boring things on planet Earth, which is the U.S. government money market fund. The idea that you can begin to integrate it and use it in payments or in the underlying ecosystem as collateral in the financial systems, it is something that offers a lot of opportunity to customers and clients because they just are always looking for that yield. Now, the global macroeconomic environment looks like something that we're going to continue to have yield on money market funds for a period of time. And so, as it relates to that other form of money, stable coins that also move like fiat, that has this key differential that you can get yield on it. And
Mm-hmm.
so we have been really aggressive and persistent on trying to tell this story and explain about, we already know that money funds are adopted by institutions and individuals all over planet Earth. It seems like there's bigger and broader total addressable markets that can be unlocked by, putting money market funds on blockchain rails. Benji just happens to be one of the industry leaders of that. And we continue to unpack those opportunities for any number of applications.
And in terms of those applications, how have you seen the buyer of the asset evolve over time? Because for most, I think at the beginning, most forms of the money market funds or other like tokenized traditional funds were created to help crypto native trading firms and crypto native treasuries sort of like manage their portfolios in a better way. But then I know you guys have sort of like expanded that to different types of venues and different types of users. Even now with Franklin's other more traditional funds also being able to tap into this type of product. So happy to learn about that evolution and how you see it playing out in the future.
Yeah, evolution is a good way to put it because it does keep evolving, all the time. Literally, the user base has, as I mentioned before,
Mm-hmm.
to own Benji, you need to be adopt and be a user of, a digital wallet, Web 3.0 wallet ecosystem. The vast majority of holders of money market funds, institutions, corporations that own these have used different large platforms to buy and sell money market funds themselves. Those platforms operated by big financial service firms, by and large, are in the process of rebuilding and retooling toward this new distributed ledger technology moving forward. And so we want to be there with product as well, to be able to get those. But it's really, you kind of follow the wallets and follow the wallet adoptions. You are correct that kind of more crypto native asset managers who are just trying to allocate within the space and are doing trades by holding stable coins and then moving into a risk asset, either back or forth. That's how they're beginning to adopt holding their balances in Benji through some sort of collateral mirroring programs that are being offered by a number of different exchanges. The friction between stablecoins and tokenized money funds, as well as other new tokenized deposits that are coming from banks, is going to be something that's going to continue to be a problem that's going to need to be solved and worked out, because quite frankly, it's hugely expensive to redeem stablecoins. And the industry has locked in this advantage about you can put your money into a stablecoin, but getting your money out of a stablecoin is not the most consumer-friendly process. And there are market makers who will make markets between stablecoins and tokenized money funds, and we're exploring those type of things. But this idea that you can have those three types of forms of liquidity moving forward, tokenized deposits, which I don't know of a bank that is not exploring the idea about tokenized deposits moving forward. And then there's obviously, you have this massive tokenized money fund. I mean, you have this massive money fund industry globally, it moving to tokenization. And then this other new form of money, stable coins. How all of that interacts, I think, is going to be a problem that's going to continue to need to be solved. And I think regulators have their eyes and understanding on that to be able to help think about how that might be able to better serve customers and clients, a solution where there's less friction inside of all that. But I think some of that's still on the come. It's going to be in the nature that the underlying funds themselves, maybe mutual funds, might be able to own some stable coin, or they might be able to be settling trades actually online, on chain, as opposed to with treasury issuance, for example. We've done some experimentation of that ourselves, quite frankly, buying treasury securities or treasury-like securities, because they're not yet fully issued by the treasury, to get to that place. So all of these are iterations and evolutions moving forward. And what we're experimenting with just in money funds, I think, is what you want to step back with and realize, well, what happens when public equities come on chain? What are the underlying underpinnings of the operations of these investment vehicles that have trillions and trillions of dollars in them? What will those need to look like? So some of this is a little bit of canary in the coal mine. There's leading indicators, and the work that we're doing that is applying to money funds right now, actually, we think extends and applies to the vast array of products and strategies. Blockchain and distributed ledger technology is hugely threatens intermediaries, right, in some way, shape, or form. And there's a lot of businesses on Wall Street that just serve as intermediaries and make a small cut of the transaction. We think all of those are probably under review and or threatened if you're in some sort of intermediary position. Things like I've been moving money. Unfortunately, my mother passed away a couple of months ago, and there's money moving between bank accounts. And it's just unbelievably amazing how Bank A, I can submit a redemption from Bank A, and then they say, I'm not going to be able to use the funds for 5 business days from now, or 3 business days plus the weekend, next week at Bank B. And I'm like, well, the money's there. Somebody's making returns on the money. That's you, the bank. What our experience with Benji is, I transfer, it transfers right now. You start getting that. You can see how that ecosystem unfolds across the rest of the financial environment in the years ahead to, quite frankly, benefit consumers and shareholders, but threaten some of these legacy intermediaries that have sat in between all these businesses.
Yeah, and many of them are now currently embarked in this core infrastructure replacement journey. It feels more like that. So not to name any names, but when you speak with traditional organizations, so like custodians, transfer agents, and so on, it feels like in part they see tokenization as an irreversible trend that they need to get on, but at the same time they're trying to replicate the structures that have enabled them to exist since the last 40 years or so.
That's right. But I think the journey for them will also unlock lots of different opportunities as well. I mean, this is the thing that I spoke about at the beginning. It's going to be disruptive. What is one of the things that some of these financial institutions can do? And I think I'm specifically talking about banks right here, right now, who have been reticent to fully embrace or promote, digital assets or this type of technology. But what we have seen a whole bunch of experimentation going on is, a bank is in the business of lending money, and they lend money based on some sort of collateral, right? I mean, a residential home, it's the title of the home that sits as collateral, for the loan. And you can think about a number of types of lending where there's different types of collateral that are needed. Well, these collateral records are maintained in databases, and they're cumbersome, they're large, they're, clunky. I can see these same things that we were experimenting with, 8 or 9 years ago with our databases that were, constraining us in some way. And you can see how replicating these things, I mean, some of these investment banks, you have to remember, they have like $20 billion annual technology budget.
Yeah.
It's $20 billion of technology budget spend that they have every year. So you can.
Yeah, and so many like core technology replacement projects that have gone terribly wrong, and
Right.
people get fired because of those transformations.
But what I am posing is that if part of this spend can help reinvent their collateral management processes in some way, shape, or form, it actually will unlock them to be able to do more lending. If they can create more efficiency in their collateral management process, they can do more lending. Furthermore, they can also begin to offload some of those assets into the broader marketplace of asset management. I mean, this is what happened almost 30 years ago now with what we call the syndicated bank loan market. We saw banks not be able to digest the entire issuance of a middle market private loan. So they created this syndicated bank loan market where there would be an issuer of the loan, and then there would be a whole bunch of investors in the loan, and they would syndicate that loan. The payments would happen, from the corp at the borrower level, and it'd pass all the way through to the investors. That syndicated bank loan market is a pretty large marketplace now for buyers of credit-related assets. But you could see this one thing that happened with the banks 30 years ago begin to be replicated across a number of their different product lines over time that would allow them to be able to make origination fees, continue to have skin in the game. That's what we learned in the global financial crisis. You can't just issue things and then walk away from it and not have some sort of risk in it. But basically be able to do that broader. In some ways, it kind of broadens the opportunity in private credit over time as these bank lines. Things like trade finance, which is hugely profitable for the banks, high interest rates on short-term loans. Boy, as a ex fixed income manager, I would love to own a bunch of that stuff for my clients because in some ways the credit quality of those assets are better than a lot of other stuff I might own. And so I'm just saying these possibilities inside of the financial institutions as they rebuild their underlying systems to use distributed ledger blockchain, I think is going to unlock a lot more investment opportunities. This is where I sunk my teeth into this many years ago. It felt like this technology was going to broaden the opportunity set of investments for institutional investors beyond what currently existed. And that was always something that was super interesting to me, not just encourage clients to go out the risk spectrum in order to get more return, but somehow to elevate that efficient frontier in some way, shape, or form. Or how about we just blow apart the idea that we don't live in a two-dimensional world of just risk and return, but there's other dimensions that we use to kind of qualify our investments. Maybe you want, Chris, your investments to have impact. So maybe it isn't a two-dimension, but it's a three-dimensional plane of experiences and assets that we can kind of bring into your portfolio itself. And this is what I think is a great promise of these technologies. Not only does it increase the efficiency of the process, but I think we begin to unlock a lot more different types of assets that can be blended into portfolios large and small for customers.
Yeah, but to your point around like banks, of course it creates, in theory, like broader opportunities for distribution, for composability of like the assets that they might create. But a lot of institutions are concerned or are trying to figure out what they're going to do on the liability side, because in the same way that the first wave of money market funds were like disrupted or had the potential to disrupt the deposit base, they see stable coins, they see tokenized money market funds as alternatives to having your deposit in a bank account. So I feel like there's banks, for example, are facing the prospect of increased competition on the liability side, on the deposit side, and everyone's just like rushing to figure out what the end game would be, and sort of like creating all these consortia so that money stays on banking rails. How do you see things like FOBXX, participating or potentially taking a greater role in how people think about, their liquid money or like settlement of payments and so on?
I think some of this is still kind of to be discovered. But I mean, let's be clear, bank deposits and money funds have existed in competition side by side for decades
Right.
now. That is nothing new. Stable coins are a new component to it, but literally stable coins are going to need to offer yield to be a real competitive product. And that's why there's so much anxiety around that from the stablecoin issuers themselves. I mean, when we talk to institutions, corporate institutions about Benji and or stablecoins, I mean, we are a publicly traded company under the symbol BEN, Franklin Templeton. Our CFO does not want to hold stablecoins because it's a dead asset. It can't earn anything. It might earn more stablecoins if it's held in a certain account at a certain prime brokerage account at one of the crypto exchanges, but it doesn't offer the yield. And so, and we're pretty sophisticated financial institutions who's building a blockchain by and large, right? You go to another widget maker and they don't know, they just want to hold their money and keep it safe somewhere. I don't think money funds are going to compete against banks in terms of service. Money funds usually out yield bank deposits, but there's no dismissing, picking up a phone call and talking to your banker and getting solutions across a number of different things. So funds are their own standalone, bankruptcy remote, not really any counterparty risk besides the underlying assets that are in the fund. And if we want to argue about the credit quality of the U.S. Treasury bills that sit underneath funds, well, then we're going to talk, that's a much larger, challenging situation to be potentially discuss. But I'm just saying that the banks, I think deposits and money funds are going to continue to exist side by side and have their usages for a number of different reasons. Banks are going to have to remove the latency in their process, and the blockchain is going to help them to be able to do that. Their tokenized deposits are going to be one way that they would like to be able to anchor in on this new future moving forward. And then, of course, the stable coins themselves are going to have to find some sort of workable way to be able to offer yield, or they're, quite frankly, they're not going to be a long-term competitive product, it feels like.
And do you feel like we spoke about the infrastructure side of things and the efficiency gains. Where do you see that pie going to? Do you think this is going to be captured by the issuers of the assets? It's going to flow into lower like fees, and how relevant is that going to be versus the other side, which would be more like the composability, the use cases in terms of where the value is going to be created?
Well, since 1986, I've kind of been in the asset management business, and where I first cut my teeth was at a firm called Bankers Trust Company back in the mid to late 1980s, and Bankers Trust Company at the time was highly competitive in the distribution of index portfolio management services to pension funds. This was about the exact same time that Vanguard introduced their S&P 500 index fund, a mutual fund itself. But I mean, there we were, we were going into these institutions and we were saying, I'm trying to remember what the fee schedules were then, but they were, probably around 10 basis points at the top line,
Mm-hmm.
gradually coming down pretty quickly depending on the size of the account by and large. And, we were competing against stock pickers who, we were charging 100 basis points for. So for 40 years, I have basically watched, fees do one thing, and they just continue to march lower. Asset management, I guess you could also argue, is an intermediary. There are firms that have capital or entities that have capital. Those would be large savings plans, pension plans, and the like. And then there's entities that want capital, people who want to start new businesses, governments that need projects that need to be financed on. And somewhere in between those two is an array of financial services between those. As you call out the pricing of those services, those that have capital get higher return on their capital over time. And this is what the great promise is going to be. I mean, literally those 85 years ago when the 40X fund came out, I would be passing you a piece of paper to say, Chris, here's your shares, the following fund. And we've, replaced that legacy, physical custodian of paper system with a number of different information-based technologies, and blockchain is just another iteration and a long-standing number of those. Now, the benefit is because each node of the network has the same record set, you're eliminating all the friction that exists in the underlying ecosystem, that where 99% of the records are the same between the two operators, but that last 1% reconciliation takes days or weeks to happen. And that's the latency that allows the financial institutions to earn that extra interest for holding your assets for 3, 4, 5 days or 2 weeks. So I think this is just the same trend that's going to be coming out. Yes, you will have higher return on assets, but I think the real unlock for institutional investors is going to be there's going to be a lot other different types of assets that are going to use this record keeping system to come on chain that is going to grow the opportunity set of investments. I think that's what's really going to happen. I think you're going to see, and maybe just a short story because I know we're running out of time here, but one of my business partners had spent a whole bunch of time here in California at one of the world's largest pension plans. And this colleague of mine was telling me a story about how that super large pension plan had consulted with Google to come in and look at their investment opportunities. And this pension plan sees every investment opportunity on planet Earth that can get an appointment, quite frankly. And yet Google mapped the Earth and they said, still, you're only seeing half of the assets on the globe, by and large, even though you see every investment opportunity that comes. And, it seems to me that this type of technology might unlock another, I don't know, 25, 30, 40, 50% of those remaining assets to come into the chain. And again, expands the opportunity set, redefines what the efficient frontier might be for better outcomes. This, I think, are the big promises that this technology and others that are unfolding in front of us, AI obviously being the biggest one, working collaboratively together in order to create better, long-term, stickier outcomes for customers and clients. The best investments for individuals that I always comment about are those investments in some sort of experience, right? How do you begin to define those? How do you begin to wrap those into when you're looking at your accounts across Robinhood and Schwab and, Merrill Lynch and Morgan Stanley? How do you begin to use these other dimensions to understand your investments beyond just the kind of the return and the volatility of those returns? These are things that are going to transform asset management as we move forward.
And thinking ahead, today, what's the relative size of the tokenized, like AUM at Franklin? Probably, I don't know, I would assume less than 1% or so.
Oh, yeah, it's still less than 1%, but
and what would be your take on where that fraction is going to sit at in 5 years from today? How quickly are things?
Here's what I can say. The biggest change that I have seen in the past 9 months are the crypto native exchanges, that these brands that have literally hundreds and hundreds and hundreds of millions of users across the planet. Those users are desperate because of the stagnant prices in the crypto digital asset space to make money, to be investing and broadening their investments beyond just crypto and digital assets. And that's why there is a massive effort by these brands to grow their real world assets, their TradFi experiences aggressively as they can. And these where the wallets are. So I think what you're going to find is that those brands are going to have, versus where they were 5 years ago or even 3 years ago. If you look out 2 years from now, they're going to have almost the entire array of TradFi assets available on their platforms. Right. That is a big change and a big opportunity, because those are customers that legacy asset managers haven't really touched in a broad way. It's going to take education. The user bases on some of these platforms are more akin to user bases on the prediction markets. Quite frankly, I'm not sure you would call those investors as much as they might be, another term. But by and large, I think that's the big change that we're seeing over the past couple of months, and the opening of those brands to have these TradFi experiences. And as you know, the TradFi markets are 30, 35 times the crypto markets in size and scope.
So do you see it more than as an adoption? Like the adoption will follow quickly if you get Coinbase, Binance, everybody, like trading tokenized stocks and funds, because they're more interesting from a capital allocation investment perspective for individuals. But on the flip side, to actually move AUM and move trading volume, you need institutional capital, the pension funds that you were mentioning. Do you see this sort of evolving from the bottom up, or are you going to see more top down as well?
My experience is the same. What I would say, if you were to see a pension fund move their record keeping system on chain, then you're going to see that pension fund also probably have a more robust digital asset allocation experience. It's kind of the same experience I was talking about with Frank Templeton, the place where there's going to be a lot of money still made. And there can be hiccups, as we've seen just in the last couple of weeks, but I think is in the market maker business. By and large, you can have pension funds who want these new type of assets as part of their asset allocation. You can have product manufacturers like Franklin Templeton and have assets in the marketplace. But underpinning all of this are market makers who are willing to have the liquidity in order to put tight markets that allow stablecoins to be traded for money market funds, or for a certain tokenized stock to be traded against something else. That is the magic sauce that exists everywhere. Now, all indications are that the market makers are really enjoying making huge profits in all of these bifurcated marketplaces. But it seems to me that they're going to be the ones that are going to continue to be pretty attractive businesses as the numbers of assets that get tokenized grow. Their opportunity to make markets underneath all those are just going to continue to expand.
And to wrap up, do you think there is a tipping point moment, meaning the moment that we get to 5% of AUM, or the moment pension funds come in, is going to be the replacement? It's going to accelerate dramatically in the same way, that we know paper at some point, paper securities no longer exist in practical terms.
I never think it's either this or that. It's always this and that in some sort of blended world. I'm kind of in between of that. The other thing I just caution people, there's the KPIs in asset management are all around AUM. You've quoted it. You said, what percentage of your AUM? But as this business starts out, this is a network business. Like for me to grow Benji, because of its kind of transferability features, its instant transferability features, it's not, the early success isn't going to be built on what AUM is. It's going to be built on how many nodes are in your network that allow the network to actually be able to, network effects to begin to happen. So, anybody who is journeying into this, I don't think should be singularly focused on AUM, but they should be, how can I get as many nodes fired up on a network? Money market funds have been around for decades. They have brands of trust that exist through a number of different economic and credit cycles and government regulation. They're not going away. But we're really, in order to get that flywheel to hum, you have to have lots and lots and lots and lots and lots of nodes on your network in order to have the nodes to be able to do the work itself, by and large. And so that's just something to consider, by and large. That I think as we define success in this space, it's not going to be just about where AUM is, because you could have one or two accounts. You could have two nodes on a network, have a lot of money, but they're not moving any money back and forth. So it's really expanding the number of nodes that might be in your network that allow these flywheels to move forward is kind of something that I would encourage people to be thinking about.
Fantastic. Well, this has been a really insightful conversation. Appreciate. Thank you so much, Roger. Great having you on the show.
Thanks, Chris.